There's a moment that comes for almost every hardworking person. You wake up one morning, look at your retirement accounts, your investment statements, maybe even the value of that rental property you've owned for years, and you think to yourself, I made it. After decades of working, saving, sacrificing, and doing your best to build a secure future, retirement finally feels real. But here's what many people don't realize. Retirement isn't just about how much money you've accumulated. It's about how much of that money you actually get to keep. And unfortunately, this is where many retirees make one of the most expensive mistakes of their entire financial lives. They spend years carefully building wealth, but almost no time planning how to sell certain assets before retirement in the most tax-efficient way possible. The result? Thousands, sometimes tens of thousands, and in some cases, even hundreds of thousands of dollars unnecessarily lost to taxes. Today, I want to walk you through 5 specific assets that deserve your attention before you retire. Not because they're bad investments, not because you should panic and sell everything, but because timing matters. And when it comes to taxes, timing can be the difference between keeping your money and giving a large chunk of it away. I've spent years helping retirees navigate this transition, and I can tell you that some of the biggest opportunities I've ever seen came during a very short window of time that most people completely overlook. Let's talk about that window first. Many people assume their taxes automatically go down in retirement. Sometimes that's true, but often it isn't. In fact, many retirees are shocked when they discover they're paying more taxes than they expected. Why? Because retirement income starts arriving from multiple directions: Social Security, pensions, IRA distributions, 401k withdrawals, investment income. Required minimum distributions. Suddenly, what looked like a low-income retirement becomes a surprisingly taxable situation. But before all those income streams begin, there's often a brief period where your taxable income temporarily drops. I call this the retirement sweet spot. It's the period between your working years and the time when all your retirement income sources fully kick in. For some people, it may last 1 year. For others, it could last several years. And this window can be incredibly valuable. Why? Because long-term capital gains may be taxed at much lower rates during this period. That means assets you've owned for years, sometimes decades, can potentially be sold at far more favorable tax rates than they would be later. I've seen people save enough in taxes during this period to pay for several years of retirement travel. I've seen couples preserve money that later paid for grandchildren's education. I've seen retirees reduce future tax burdens so dramatically that they gained far more flexibility throughout retirement. And it all started with one simple question: what should I sell before retirement? The first asset category is appreciated company stock inside a retirement plan. This one catches people by surprise all the time. Maybe you worked for the same employer for 20 or 30 years. Maybe you participated in an employee stock purchase plan. Maybe company shares accumulated gradually inside your 401k. Over time, that stock grew and grew and grew. Now it represents a substantial portion of your retirement savings. At first glance, you might assume the simplest solution is to roll everything into an IRA when you retire. That's what many people do, but sometimes the simplest option is not the most tax-efficient one. In certain situations, employer stock may qualify for special tax treatment that can significantly reduce future taxes. The key is understanding your options before making irreversible decisions. I've met retirees who unknowingly gave up enormous tax advantages because they rushed through retirement paperwork without understanding the consequences. The paperwork looked routine, the rollover seemed harmless, everything appeared straightforward. Then years later, they learned that a major tax opportunity had disappeared forever. That's why I encourage anyone approaching retirement with significant employer stock to slow down, take a breath, ask questions, understand what you're holding before you move anything. Retirement decisions should never be made on autopilot, because once certain transactions happen, there is no rewind button. Now let's move to the second asset category. And honestly, this is one of the most common situations I see among successful investors: concentrated stock positions. You know how this happens. Someone buys shares of a company they believe in. The company performs well, the stock doubles, then triples, then multiplies again. Years pass. Suddenly, one stock represents an enormous portion of the portfolio, maybe 20%, maybe 30%, sometimes even more. The investor feels grateful because the stock helped create significant wealth. But there's also a growing problem: too much dependence on one company. I understand the emotional attachment. It's hard to sell a winner, especially when that winner helped fund your retirement dreams. But retirement changes the conversation. When you're working, you have time to recover from market setbacks. You have income. You have flexibility. Retirement removes some of that cushion. Now, your portfolio may need to support you for 20 or 30 years. That's why diversification becomes so important. Yet many retirees become trapped, not because they don't understand diversification, but because they fear the tax bill. They look at the gains and think, if I sell this stock, I'll owe so much in taxes. So they delay, then delay again. And eventually, years pass while the concentration risk continues growing. The danger is that taxes begin making investment decisions instead of investment principles. That's never a good place to be. A well-designed retirement plan should balance risk management with tax efficiency, and sometimes that means gradually reducing concentrated positions before retirement income reaches its highest levels. I've worked with people who diversified carefully over several years rather than all at once. They spread gains across multiple tax years. They reduced risk methodically, and they created portfolios that allowed them to sleep better at night. Because retirement isn't just about maximizing returns, it's about creating peace of mind. And peace of mind becomes incredibly valuable once the paychecks stop arriving. Here's something else worth remembering: no company is invincible. History is full of businesses that once seemed unstoppable, companies that dominated industries, companies investors believed would last forever, yet many of them eventually struggled. Some disappeared completely. Retirement is not the time to bet your future on the assumption that one stock will always remain a winner. The goal isn't perfection. The goal is protection. And that's exactly why reviewing concentrated positions before retirement can be one of the smartest financial moves you ever make. Now let's talk about the third asset category: real estate. And I know this topic can be emotional because for many people, real estate isn't just an investment, it's a story. It's the rental property you bought when nobody believed you could. It's the vacation home where your family created memories. It's the duplex that helped supplement your income while you were still working. Over the years, those properties may have appreciated dramatically. What started as a $200,000 or $300,000 purchase may now be worth 2 or 3 times that amount. On paper, that's wonderful news. But retirement introduces a new question: what role should that property play in the next chapter of your life? Some retirees love being landlords. They enjoy managing tenants. They don't mind maintenance calls. They appreciate the monthly income. If that's you, fantastic. But many people feel differently once retirement arrives. After decades of working, they don't want another job. They want freedom. They want flexibility. They want to travel without worrying about a leaking roof or an emergency repair. And that's where the decision becomes complicated, because selling real estate often means facing a significant tax bill. Many retirees see that potential tax liability and immediately decide not to sell. But remember something important: a decision based solely on avoiding taxes is not always the best decision. Sometimes holding on to a property that no longer fits your retirement lifestyle costs more than the taxes you fear. It costs time, it costs flexibility, it costs peace of mind. I've seen retirees spend years managing properties they no longer wanted simply because they were focused entirely on avoiding taxes. Meanwhile, their retirement goals sat on hold. The challenge becomes even greater because rental properties involve another layer of taxation that many people underestimate: Over the years, landlords typically claim depreciation deductions. Those deductions can provide tremendous benefits during ownership, but eventually, when the property is sold, some of that benefit gets recaptured, and that can create a surprisingly large tax obligation. The result? Many retirees discover that the actual tax bill is much larger than they expected. That's why planning matters so much. The question isn't simply, should I sell? The better question is, when should I sell? Timing can dramatically influence outcomes. A carefully planned sale during lower income years may produce a significantly different result than a sale occurring after multiple retirement income streams are already active. And that's where strategic planning becomes powerful. Because retirement shouldn't be driven by fear. It should be driven by intention. You should own real estate because it serves your goals, not because you're trapped by potential taxes. And that brings us naturally to the fourth asset category, business interests. For entrepreneurs, this may be the most important conversation of all. If you've built a business, you already know something most people never experience. You know what it's like to risk everything. You know what it's like to work late nights. You know what it's like to solve problems nobody else sees. And if you've spent 20 or 30 years building a successful company, the value of that business may represent a huge percentage of your net worth. For many business owners, selling the company becomes the largest financial transaction of their lives, larger than their home, larger than their investment accounts, larger than anything they've ever dealt with financially. That's why the exit strategy deserves as much attention as the growth strategy. Unfortunately, many entrepreneurs spend decades building their businesses, but very little time planning how they'll eventually leave them. They focus on revenue, they focus on growth, they focus on expansion. Then suddenly, retirement arrives, a buyer appears, an offer is made, and decisions that should have been considered years earlier now need answers immediately. That's a dangerous position to be in, because once a transaction closes, many planning opportunities disappear forever. I've seen business owners save enormous amounts simply because they started planning early. Not months before retirement, years before retirement. They understood the tax implications. They structured transactions thoughtfully. They coordinated their sale with the rest of their retirement plan. And as a result, they kept far more of what they spent decades building. One thing I often tell business owners is this: the goal isn't merely selling the company. The goal is converting the value of your company into lifelong financial security. Those are two very different objectives. A large sale price doesn't automatically create a successful retirement. What matters is how much remains after taxes, how those proceeds are invested, and how they support your lifestyle over time. That's why retirement planning and tax planning should always work together, because every dollar you unnecessarily lose to taxes is a dollar that can no longer work for your future. Now let's discuss the fifth asset category. And this one surprises people because it seems so harmless. Appreciated mutual funds, ETFs, and brokerage account investments. These accounts often feel safe. They're familiar, they're flexible. They've quietly grown in the background for decades. Maybe you contributed every month. Maybe you invested consistently through good markets and bad. Maybe you stayed disciplined when others panicked, and now those investments have become a significant source of wealth. Congratulations if that's your situation. That's exactly what long-term investing is supposed to accomplish. But hidden inside those accounts may be something many retirees overlook: large unrealized gains, sometimes very large unrealized gains. I've reviewed brokerage accounts where investors originally contributed a few $100,000 and eventually accumulated portfolios worth several times that amount. The growth was incredible. The discipline paid off. But so much appreciation created a new challenge: taxes waiting in the future. Many investors assume they'll simply hold these assets forever, and sometimes that's exactly the right strategy, especially if the goal is leaving assets to heirs. Current tax rules often provide substantial advantages when appreciated assets transfer to beneficiaries. But life doesn't always follow the script. Retirement is full of surprises. You may decide to travel more than expected. Healthcare costs may rise. Family needs may emerge. You might want to help children or grandchildren. You may discover opportunities you never anticipated. And suddenly those brokerage accounts become a source of spending. At that point, unrealized gains become realized gains, and taxes enter the picture. This is why pre-retirement planning can be so powerful. Instead of waiting until future income sources create higher tax exposure, some retirees strategically realize gains during years when their tax situation is more favorable. What makes this strategy especially attractive is that it often doesn't require abandoning investments. Many investors hear the word sell and immediately think they must move everything to cash. That's not necessarily true. In some situations, investors can sell appreciated positions and immediately reinvest, effectively resetting their tax basis while remaining fully invested. The market exposure remains, the portfolio remains, but the future tax picture improves dramatically. Think about that for a moment. You're not changing your belief in the investment. You're improving your tax position. That's a very different objective, and when executed thoughtfully, the long-term benefits can be substantial. Now, after discussing all 5 asset categories, let's step back and look at the bigger picture. Because retirement tax planning isn't really about stocks. It's not really about real estate. It's not really about business sales. It's about understanding how all the pieces fit together. The most successful retirees I've worked with don't view financial decisions in isolation. They see connections. They understand that one decision affects another. A large stock sale impacts taxes. Taxes impact Medicare premiums. Medicare premiums impact cash flow. Cash flow impacts withdrawal strategies. Withdrawal strategies impact investment allocations. Everything is connected, and that's why retirement planning should never be reduced to simple rules of thumb. Your situation is unique. Your assets are unique. Your goals are unique. What works beautifully for one retiree may be completely inappropriate for another. That's why thoughtful planning matters. The people who typically benefit the most begin preparing several years before retirement, not because retirement is complicated, but because flexibility is valuable. Every year before retirement gives you another opportunity to make smart decisions, another opportunity to manage gains, another opportunity to position assets strategically, another opportunity to reduce future tax burdens, and perhaps most importantly, another opportunity to create confidence. Because confidence is one of the greatest gifts financial planning can provide. Not confidence that markets will always rise, not confidence that life will always go according to plan, but confidence that you've prepared thoughtfully, confidence that you've considered your options, confidence that you've positioned yourself to keep more of the wealth you've spent a lifetime creating. If there's one lesson I hope you take away today, it's this. Retirement is not simply the end of your working years, it's the beginning of a completely new financial chapter. And the decisions you make during the years leading up to retirement may have a bigger impact than many of the decisions you made while building your wealth. The difference between acting early and waiting too long can be measured not in hundreds of dollars, but in tens of thousands or even hundreds of thousands of dollars over the course of retirement. That's real money. That's real freedom. That's real security. So take the time to review your appreciated assets. Understand where your gains exist. Identify your opportunities. And most importantly, don't wait until retirement arrives to begin planning for retirement, because the people who keep the most money are rarely the people who earned the most. They're usually the people who planned the best. And after a lifetime of hard work, you deserve to keep as much of your money as possible.